Welcome to the Signal Fire Angel Summit. I'm Trace Cohen. I'm the moderator, your hostess for the mostest right now. And my quick background is I am an angel investor through New York Venture Partners, a family office. We do pre-seed seed investments, 50,000 plus into opportunistic companies. And as of today, we committed to a few more. So we're around 57, 58 direct investments. And I actually do not invest in syndicates, which is why I was very curious to host this panel. I'll introduce Ed Roman now of Hack VC. So early jobs during and after college, he went to Cornell and studied comp sci, a software engineer at Trilogy, then built middleware to about 6 million in revenue in 5 years and sold that to Precise Software, an Israeli company. Then Ghostfire Games for another 5 years. He then started Hack Hands for a year, which he sold to Plural Insights, which then went public and then got acquired. During that time, because he wasn't busy enough, he also started Hack Summit in 2014, which turned into Hack VC in 2017. According to Crunchbase, you have about 59 investments. AngelList, you started there around 2010. Couldn't tell if it was an investment or a syndicate or around what year, but some of your investments are in Canva, Molecule, Sauce Labs, and Standard Cognition. And Ed, if you could just kind of fill in the blanks of what I missed and clarify how you got to become a VC.
So I started off as an entrepreneur, and I became an investor over time. And I made a lot of mistakes initially as an angel investor, but then my deal flow improved, and I got better deals over time. And a lot of my friends wanted to invest in the deals that I was finding as my deal flow improved. So I started a syndicate to help those investors get into those deals. And then, that started to build a reputation. And I very much looked at this as a long-term path to becoming a venture capitalist because, technically with syndicates, you get deal by deal carried interest, you get deal by deal economics. So there's a temptation that most syndicate leads have to do as many deals as possible, right? Because you have upside on any deals that work out, and the winners and the losers don't balance each other out. I was trying to be careful to not fall into that trap because my whole goal was, what if I could build a long-term track record here as a venture investor and use that as credibility to raise a venture fund? So I basically invested in over 100 deals using syndicates. That gave me credibility to raise a very small set of funds. So these are like $1 million AUM funds. And then that gave me credibility to raise a larger fund, which is what I operate right now, which is called Hack VC. We had the historical track record audited, and it's basically top decile performance. It's about a 28% net IRR to investors. So it's kind of up there with the best venture funds in the world. So we got fortunate in some good companies there. And now we have this larger venture fund. And the strategy with a larger venture fund is that we're investing in B2B software companies. We think that's an attractive asset class to invest in because it's software margins, it's recurring revenue, it's B2B, you're selling to businesses that are wasteful. And also, we run the world's largest programmer conference, which is an online event for software developers. And that's a place where programmers can learn from other programmers. Our largest event has had 80,000 attendees from 157 countries. And in total, we've had 135,000 programmers from around the world attend our events. They're all online events, by the way. They're all fully virtual, happening before the pandemic, because we thought virtual conferences were kind of an important thing. And we leverage that to help startups hire engineers out of that audience. That's kind of our strategy as a venture firm right now. So I'm grateful to AngelList and to that community because they really gave me my start. Because a lot of you folks in the audience, you might be aspiring managers. Maybe someday you hope to aspire to become a venture capitalist. But there's a chicken and the egg problem from a credibility perspective because how do you actually get started in this industry? And there's several paths. One path you could do is you could join a venture firm as an associate, hope to get promoted, right? But kind of, your path is a little bit outside of your hands. You're kind of beholden to promotion from others, right? For me, I've always been an entrepreneur. I've started 3 companies. So I kind of want to do my own thing. So syndicates represented that path to building credibility for me. So now we're fortunate we have institutional capital. We've got that track record. We now have 4 companies worth over $1 billion. And so it's been a long path, but we're kind of glad to be a small part of the venture ecosystem now.
Yeah, definitely seems like you both have a lot of experience to be that value add smart money. And so I want to touch on the point that you mentioned, how you started with syndicates because you had deal flow that you wanted to share with your friends who weren't either in the tech world, who didn't know really how to invest. And so what did you start out doing as a syndicate lead? Did you expect it to be an institutional fund later on? Was it kind of a side hustle when you started? Because I have a lot of friends who run syndicates, and they have friends who start companies, or they have the goal of starting a fund, but they need a track record. Was that how you started it, or was it kind of just like 2010, 13-ish, and you're like, this seems really cool, it's a nice platform, let's see what happens?
I think it depends on the personal situation of the syndicate lead. So some syndicate leads have had a lot of success in life, and they've had an exit, for example, they've sold a business. Versus for other syndicate leads, they're just getting the start in life, and they don't really have a large bank account to work with, so they might have to ration their capital a little bit more. So, when AngelList first started and they first started doing syndicates, they started looking at how big a commitment is the lead doing into these deals. Should that be indicative of is it a good deal or is it a bad deal? Should LPs care about that? And I think ultimately over time they realized that initially they thought that mattered a lot, and I think they've relaxed that constraint over time because everyone has a different personal situation.
Got it. So you just happened to do an AngelList syndicate by happenstance. You're like, hey, I need to raise a lot of money for a pro rata. What can I use out there?
We're kind of at the point now where our syndicate has gotten actually a little bit too large, and we have to figure out a better way to manage it, because we've had over 2,000 LPs apply to join our syndicate. We've actually had to remove hundreds of them from the syndicate because they haven't been consistent at investing in our syndicates. And there's a privacy concern that the entrepreneurs have where, imagine you're building the next Uber, the next Airbnb, you've got term sheets from multiple venture firms, and there's this syndicate that wants to co-invest with you. Do you really want to show your KPIs to, thousands of people, right? Could that be a competitive risk for you as a founder? So what we've had to do is we've actually had to reduce the size of our syndicate. So these days, if someone applies to join our syndicate, we actually don't show them very many deals at all initially. We might show them like maybe a couple deals per year, maybe, and they'll have to prove that they're consistent at committing capital. And then we kind of graduate them up. So for any given deal, we're probably inviting between 5 and 10% of our syndicate to join those deals, just from a privacy perspective. So it's not that hard to get our deals oversubscribed at this point because the syndicate's been around so long. But in the early days, it was really tough and it was very unpredictable. So, so what I know that some folks started to do is they started to actually guarantee capital to the entrepreneur. They used to say, hey, I'll guarantee the $250K personally. And if the syndicate can't make it up, then I'll cover it. And that was a way to get the entrepreneur to feel better about it. Because if you don't do things like that, you could suffer from adverse selection. Because if that entrepreneur has offers from other real funds that have committed capital, they're going to choose that over a syndicate that's unpredictable, basically. So little tips like that over the years have informed us on how to do these better.
So how did you get started in the syndicate world?
For my story, I had spent a large amount of time building trust with other venture firms over the years, where because syndicates invested small checks, we were naturally complementary from an ownership perspective with those other venture firms. So instead of competing with the other venture firms, we were complementary to them, which means that I realized I could tap into them to assist with the fundraising efforts to raise a venture fund. Because if you think about it, right, if you're complementary to their business model, if you can partner with them on deals and be a source of deal flow for them, then they are intrinsically motivated to see you succeed as a venture capitalist. So the first thing I did was I spent about 2 months just meeting venture firms, not meeting LPs, just meeting VCs and giving them the pitch that I would give to LPs. And I just wanted their feedback on the pitch so I could improve the pitch, basically. And then they offered to introduce me to their LPs because they wanted to see this venture firm succeed, because if we succeeded, then it would represent a form of deal flow for those venture firms. And some of those venture firms offered to invest in our venture firm, which was a little bit surprising because they're actually sometimes double paying on the economics, right? Because they charge their economics, right? But they view that as de minimis because their funds are so large, they're okay with that, right? So
to all the people here, I see your questions, 123 people. There's also polls open. I don't know if you've answered them. I'm trying to figure that out. I'll close them towards the end so we know who you are. I have one more question and then we'll go into your questions. And so how did you make the transition from a syndicate to a an established institutional fund? Did you go to people who invested in your syndicate, family offices, high net worth individuals? Who were, I guess, your early LPs? And what was the difference between raising for every single deal opposed to doing kind of capital calls and more LP investor updates with people you knew had capital to commit?
The social proof that we got from those other venture firms investing in us really helped a lot, because then we had a story we could share with LPs, that we had other venture firms that, that had credibility, that believed in us, and that invested in us. And then the LPs that we had from our syndicates also reinvested in our fund, because they saw that what we had accomplished through syndicates, and they liked what they saw, so they wanted to get more of that. They learned to trust us over time. Initially, it's funny because the big trend right now is deal by deal. That's what a lot of LPs are looking for. Family offices in particular, even pension funds for that matter these days, are starting to dabble in investing in deals directly rather than going through venture firms, because everyone has an intuition about what makes a good startup, and it's very tempting to actually act on what you believe is a good investment. And I can appreciate the natural human desire to do that. It also reduces your fees if you do that. So one of the things that we dangled in front of LPs was, hey, if you invest in the venture fund, then we'll give you direct access to these deals as well, either through SPVs or through you investing directly. And that was very valuable in terms of helping us fundraise. Oh, my most recent investments. So with our new venture fund that we closed in March of last year, we were investing in a lot of kind of COVID pandemic companies that were actually riding the tailwind of COVID, where they were in the digital transformation category, and that was helping them. So some of those are starting to overperform right now. One of the examples of that is a company called Cribble.io, CRIBL.io, which is it's a boring software as a service company. That's the kind of stuff that I invest in. And they basically, if any of you guys are familiar with log management companies like Splunk or Elasticsearch, they basically log a bunch of data. They store it in a giant database. It's terabytes and terabytes of data, and you need that data because that's your log for your business, right? But it turns out that you're paying per terabyte or per gigabyte for this data, and most of the data you never actually use. So what if you could filter that data for data that was stuff that you actually would use? You could log less data then, right? So that's basically what Cribble is doing, is they're a log filtering system, and they save you millions of dollars. So instead of paying Splunk or Elasticsearch $10 million a year, what if you paid them $1 million a year? Because you don't need to log all the data that you think you need, basically. So it's a very simple value proposition. So we invested in that company from our new venture fund, and then Sequoia ended up leading their most recent Series B round that closed last year. So we're pretty excited about that one. So that's a good example of what we invest in. It's like very boring businesses that tend to have overall a better financial return because they're predictable, basically.
Very cool. So we only have 4 minutes left, and I like to end with some values. So kind of like your closing statements. Is there anything you need? What ask or help can the 100+ people here do? Pimp one of your last publicly announced companies, and any closing thoughts.
I guess from an audience perspective, one thing that might be useful for you is if any of you are aspiring investors and are looking to either lead syndicates or invest in startups or invest in venture funds, I did create a PDF, which is like a series of best practices. And basically that PDF is essentially lessons learned over the years from the mistakes that I made as an investor. And my goal with creating the PDF was, how can I reduce the amount of waste in the world? Like, how do I reduce the number of bad investments made? And that way we can just more intelligently get into better deals together and learn from each other, basically. So if that's useful for the audience, I'll type my email address in here. This is my email address. And if you guys want to email me, I'm happy to send you that PDF.
Well, thank you very much. That was our allotted time. That went by fast because this is a lot of fun. I'm feeling better about syndicates, rolling funds, and maybe I'll start my own fund as well. I've considered it. Hopefully we can invest together. Thank you to the 100+ people who showed up here and asked a bunch of questions. We really appreciate it.